here ended higher, so it kind of follows on from that, but this is nothing. Let's just take a very quick look at what else is doing well. I'm just going to stick with the futures and options pack. So ONGC is the top gainer. It's up about 3%. M&M Finance is reacting, of course, pre-quarter numbers there. Abhishek had put out the data. Gujarat Gas is up 2%. There is Deepak Nitrite, almost 10% up. Deepak Nitrite is up another 2.25%. There is JK Cement, which is up 2 1/3. Abbott India is up about 1.25%. So there is, that's basically the top gainers. Fast changing, but for now, this is what is doing the best. Deepak Nitrite is picking up pace. Deepak Nitrite, of course, is a management which we will speak to in just a bit from now. What is lower is India Mart, Bharat Forge, Petronet, and Mindtree. These are the losers. But again, in the 1 to 2% odd range. And all these part of the F&O side of things. What else? I think it's too early to look at broader markets because volumes are still kind of thin. But there's Patel Engineering, for example. But again, volumes are 12%. There is GNFC, which is up 4%. Adani Green is up about 4%. Chemplast is up about 2.5%. Hindustan Copper. And you go down the list and you'll find more, but I think we'll just give it some more time for broader markets to kind of settle down, volumes to really start to show up at this point. Mitesh, what do you make of the open? Just 14 points cut.
The open is much stronger, Prashant, and I think, given the fact that, we've kind of sustained this, or we've shown this resilience around the higher end of the range, I think a break about 17,750 could involve some taking off long positions with a stop of about 35 points, and I would look at a target of around 17,900, 950 as the bigger range, as the upper end of the bigger range.
Okay, just want to point out that ONGC is, of course, running away 4%. We were just discussing this stock before the open. Even the refiners, IOC and BPCL, are having a pretty good morning. The overall buzz is, and the expectation is that gross refining margins will start improving, and some of that perhaps is showing up in stock prices already. So, Anuj, here we are. There's not much of a gap down really at the open. So how does one sort of negotiate a day like this? Would you expect maybe a second dip at some point in time?
It may happen, the second dip, Surabhi. But, normally it happens because that it becomes a bit of a consensus that, okay, the market just bought the first dip because, the global nature. But what it's given you is that, once again, that risk-reward trade would have worked. The first thing in the morning, if you would have bought with SGX Nifty as a low. Now it will be interesting to see if we break the morning low or not. So that's why first hour becomes important, and that's, you keep tracking it. But, some of these energy stocks and all these stocks are clearly doing well. Let's thank Mitesh on that note and invite our market master for the day, Pratik Gupta, the CEO and co-head of institutional equities at Kotak, is joining us. Pratik, good morning. Thanks for joining us. Indian markets on steroids, nothing's bothering it, right? So how do you approach it now?
Hi, good morning, Anuj. Yes, you're right. Our market has actually been one of the best performing markets in the world. In fact, I was just looking at the numbers yesterday. India is now an outlier versus almost all emerging markets. We are up 27% year to date, whereas the MSCI EM index is actually down 3%. China is down 7%. We have Malaysia down 6%, and so on. I think it's only markets like small emerging markets like Sri Lanka and Argentina or Poland, which are up some 40-50%. But amongst the large emerging markets, we have been the best performing market. Clearly now at this point, valuations have become an issue. In our conversations at Kotak with global institutional investors, I think this is a unanimous complaint that while people do want to invest in India, given what's going on in China, and there is definitely a willingness to shift into India, but at the same time, the valuations are keeping people at bay. We are trading at about slightly over 21 times FY23 earnings. And that itself is quite well above the historical averages. So by and large, what we're seeing is this market is being driven more by retail investors. You've seen this in the number of demat accounts, number of active broking accounts, the kind of participation you're seeing in the single stock futures market where the net long positions have actually crossed $11 billion. So this is a market which is being driven more by retail investors rather than by institutional investors. Even the domestic institutions which have generally been net buyers, that money is really again coming from the domestic investors. So our market is being driven more by domestic flows, more by retail investors, and valuations, frankly, at this point do call for some caution at the current levels.
Pratik, hi, good morning. So there used to be a time when you could get a sense on looking at the flows on the institutional side and get a sense of which way the wind is blowing. Now, as you said, I mean, there's this almost synchronous, unified entity called retail, right? Which can do wonders. So where does that leave you? And in terms of your advice, because you look at what's happening, right? I mean, global cues, etc. I mean, it's starting to matter less and less because there is this very large pool of money here locally. I mean, how does so you can stick to your discipline, look at valuations, stay away, but then prices keep going higher. What's your sense? What does one do?
I think you're right. As if you're sticking to your discipline in the short term, you could sort of lose out. The market may continue to run up. In fact, even now, we don't see any immediate trigger for the market to come off, despite our concern that the valuations are getting on the expensive side. I think the one main thing we should watch out for is an increase in global bond yields, the US bond yields in particular. And you've already got the Fed talking about tapering, and the other central banks some of them have begun increasing interest rates. Locally, I think it's really the RBI, which is also likely, in our view, to keep interest rates on hold for right now. But frankly, from a retail investor perspective, what's happening is the alternatives are not yielding good returns, whether it's bank fixed deposits or other fixed income products, and or real estate or gold. So therefore, as a result, the equity market, which has performed well, and you see your neighbor doing well, so it just becomes you start getting more and more flows into the equity market. But sentiment can change on a dime, and that's where I think all of us have to be very, very careful and stick to the valuation discipline, even if it means foregoing a little bit of returns in the near term over the next 3-6 months. Maybe the market continues to rally another 5-7% or so. But I think one does have to be careful, because as and when the global liquidity tightens, or as the central banks over there withdraw, as RBI over here starts withdrawing, then I think you could see sentiment turn. When it turns, we don't know. But sometime in the next 6 to 9 months, that is a pretty, a fairly high probability. The only point I would make is this time around, given India's very strong economic outlook over the next 2-3 years, we don't think the correction will be very steep, unlike, let's say, what we saw in 2013. I don't think you'll see a 15-20% odd correction. It could be a bit more modest. There is a lot of institutional money waiting on the sidelines, which has missed out on the India rally, which is waiting to come in. So I think the correction will be somewhat mild, or maybe you just go through a period of time consolidation.
Explains why the definition of correction in the Indian markets come down to like a 1% dip, or maybe a 2% at max, Pratik. By the way, I just want to point out that the oil and gas space is red hot in the market today. ONGC, IOC, all of these stocks are up in any case. Let's pull up some of the city gas distribution players, because as Sonal just alerted us, Gujarat Gas has undertaken a pretty steep hike. On the industrial gas side, on the industrial segment, it's I think about a 9 rupee hike, and on the CNG segment, it's I think about a 2.5 rupee, the retail segment. The stock is running away. Of course, right now the market seems to be taking a view that TINA, there is no other alternative, that you keep hiking prices, but consumers won't shift. So demand